What is a term sheet for? When should you enter into a term sheet? And what should the term sheet contain? The term sheet is a summary of the main commercial and legal terms agreed between the parties. It sets out the main aspects of the investment, but it is not legally binding. So then why is it so important? The term sheet does bind the parties morally and commercially, and it would be very hard to row back from the agreed terms later on. So the time should be taken to get it right at the start. Two provisions which are legally binding in a term sheet are the confidentiality and exclusivity provisions. Confidentiality, covering information disclosed to the investor throughout the negotiations, and exclusivity to prevent the managers from negotiating with other third parties during a fixed period. You should agree the term sheet as soon as you have found your investor or investors and agreed with them the type and value of the investment. Given the importance of the term sheet, it shouldn't be drafted from scratch, and many investors are likely to have a template term sheet which they will use. Lawyers should be engaged early on to assist with the drafting and to advise on the key legal terms you may not have thought of, and matters only negotiated once at the outset will keep legal costs to a minimum in the long run. It's worth bearing in mind when you are negotiating the term sheet that this may well be the time that your position is at its strongest, which makes it a good time, if your lawyers are involved, to agree the deal points which are important to you. So what should the term sheet contain? This can be split broadly into four main categories. First, those that describe the amount and the type of investment, so the price per share which goes to the valuation of the company, and the equity split. The second category describes the investor's economic rights, as the investor will want to ensure that it gets its money back before other shareholders on a sale, IPO or winding up. Third, the investor's control rights, so that investors can make key executive decisions and have veto rights over fundamental decisions of the company. You should determine at the term sheet stage how much control you are willing to give your investor. The fourth category describes the level of protection the investors will benefit from, for example, by way of warranties from the managers in the company. And remember that although the term sheet is not legally binding, it imposes a moral obligation on the parties to stick to the agreed terms, and it will be very hard to vary any terms when it comes to drafting the deal documents later on. So it is important to seek advice and get the deal terms you want at the outset. Thank you for listening, and do get in touch with us if you have any queries.